If you want to know how a company prints money without touching the money, look at Mastercard. It's the toll booth on the global economy, and from 2020 to 2025, it quietly doubled revenue while barely breaking a sweat. 1. Business model. Mastercard runs a global payment network linking issuers, acquirers, and merchants. It earns fees on transactions, value-added services, and data products. It's asset-light, scalable, and profitable. From 2024, revenue rose from 15.3 billion to 28.2 billion, proving its operating leverage as digital payments accelerated and travel recovered. 2. Economic moat. The moat is undeniable. Network effects, entrenched global brand, merchant acceptance, and regulatory relationships. Banks can't easily switch without losing scale. Merchants can't afford not to accept Mastercard. Added services, fraud detection, tokenization, deepen stickiness. It's a textbook Buffett-Style franchise. 3. Management quality. CEO Michael Miebach has continued Ajay Banga's disciplined playbook. They've reinvested in services, executed acquisitions carefully, and returned capital aggressively. Transparency with investors is consistent. Regulatory scrutiny is a constraint, but capital allocation has been Buffett-worthy. Repurchases, rising dividends, and reinvestments in moat-widening technology. 4. Revenue growth. From the 15.3 billion in 2020 to 28.2 billion in 2024, Mastercard posted a CAGR around 14–15%. Drivers included gross dollar volume growth, rebound in cross-border transactions, and deeper value-added services. By 2025, quarterly net revenue was still growing in the mid-teens, a sign the secular trend isn't slowing. 5. Profit margins. Operating margins remain among the highest in corporate America, with net margins historically near 40%. Rising transaction volumes directly flow to EPS and free cash flow because costs are fixed. These are dream economics that Buffett always talks about: huge scale, minimal incremental costs, fat margins. 6. Earnings consistency. Earnings fell briefly in 2020 but rebounded fast. From 2021 through 2024, EPS growth was steady, fueled by higher volumes and buybacks. As a network operator rather than a lender, Mastercard is less exposed to credit risk. That steadiness is exactly what a Buffett investor values. 7. Return on equity, ROE. ROE consistently tops 20%, far higher than the S&P 500 average. That reflects an asset-light model, durable margins, and capital return policies. High ROE is Buffett's shorthand for durable business quality, and Mastercard delivers it year after year. 8. Return on invested capital, ROIC. ROIC comfortably exceeds its cost of capital. Even conservative measures put ROIC well above 15%, with cost of capital around 8%. Mastercard's incremental investments in services and partnerships yield attractive returns, reinforcing its moat and protecting shareholder value. Hook number 2, midpoint. Buffett always says he'd rather buy a great business at a fair price than a fair business at a great price. Mastercard is clearly the first. The debate is whether the price tag justifies joining the party. 9. Debt levels. Debt grew from 12 to 13 billion in 2020 to about 18–19 billion in 2024–25. Cash sits around 9.4 billion, leaving net debt 9 to 10 billion. Leverage is modest compared to earnings power, though rising rates could nudge interest costs. Overall balance sheet health is solid. 10. Free cash flow, FCF. FCF rose from 10.1 billion in 2022 to 13.6 billion in 2024. Cash conversion is excellent, and excess cash easily covers dividends, buybacks, and selective acquisitions. FCF consistency is the cornerstone of Buffett's valuation framework, and Mastercard's record is pristine. 11. Valuation metrics. Market cap in 2025 hovered around 500 billion with a PE well above the market average. Investors pay a premium for resilience and growth. That premium is the key risk. High multiples demand ongoing flawless execution and sustained double-digit growth. 12. Intrinsic value estimate, DCF plus comps. DCF assumptions, FCF 13.6 billion in 2024, 10% growth for 5 years, 3% terminal growth, 8% discount rate, 906 more shares. That yields $407 per share intrinsic value. With shares trading mid-500s to $600, the stock looks pricey. Comps confirm Mastercard trades at a premium to peers. 13. Dividend policy. Dividend yield is small, but payouts grow annually. More importantly, buybacks dominate. A 12B authorization in 2024 shrank share count meaningfully. The policy favors shareholders long-term, exactly how Buffett likes it. Modest dividends, heavy buybacks when cash gushes. 14. Industry outlook. Global electronic payments keep expanding as cash shrinks. Emerging market adoption, cross-border trade, and digital wallets fuel growth. Risks include real-time payment systems and fintech challengers, but Mastercard's brand, scale, and regulatory ties protect it. Expect industry growth to remain high single digits to low teens. 15. Risks and red flags. Key risks: regulatory intervention, fee caps, antitrust, fintech disruption, cyber threats, and macro downturns. With valuation already rich, any stumble could mean sharp multiple compression. Cross-border revenues remain vulnerable to geopolitical and travel disruptions. DCF and valuation recap 2024. FCF 13.6B. Shares 906 MN. Growth 10% for 5 years. Terminal 3%. Discount 8%. Intrinsic value 407 to share. Market price 2025 $580-600 premium suggests limited margin of safety. Mastercard is a machine. Fat margins, high ROE, sticky moat. But Buffett would remind you, even the best business becomes a bad investment if you overpay. At today's price, Mastercard is a hold, not a buy. A dip toward $400 changes the story. 12-month target, $450 margin of safety, rounded 25% below market. Verdict: hold. Brilliant business, stretched valuation. Buy only if price falls closer to intrinsic value or growth accelerates meaningfully.